Welcome to Money Talk with Michael. I'm Michael Eastham, president of Fellowship Financial Group. Money Talk with Michael is our weekly broadcast where we answer your questions about finance, investment, retirement, and all things related to money. Remember to send in your questions to the email listed in the description box below, and you might hear your question answered on the next Money Talk with Michael.
I'm going to have to start taking RMDs next year, but I'm single and don't need the money. My biggest concern is long-term care because I don't have any family locally that I could rely on. Would it make sense for me to use the RMD to purchase some long-term care insurance?
All right, great. A long-term care question. Well, this can actually work very well if done in the right way, but you need to consider taxes, for example, before you commit to a policy. And here's what I mean by that. If your RMD is $10,000 and the taxes on that are going to be $2,000, you don't want to commit to more than an $8,000 policy premium unless you have resources elsewhere. So keep that in mind. Also, there are several types of long-term care policies that exist out there. One is the traditional vanilla long-term care policy that's kind of like a term life insurance policy. You pay premiums, and if you don't use the policy, well, then it doesn't really do you any good. You don't get that money back. However, over the last several years, there have been some policies that have come out there, some programs that are asset-based or hybrid policies. This allows you to take a bucket of money or policy premiums like your RMDs, put them into that policy, and those funds may be available to you in terms of cash if you decide, 10 years or 20 years down the road that you don't need the policy. You can get all or even a portion of your money back by using that type of policy. You see, the interesting thing is that the benefits can leverage your premiums exponentially at a time when you actually need it. So that is a very important thing to take into consideration. And then finally, the reality is that most people won't need a long-term care benefit until they're in their 80s, early, mid, late 80s. And if you think about it, with inflation, the costs of healthcare are going to be much, much higher if you start that policy when you're 65 or 70. An inflation rider on a hybrid or an asset-based long-term care policy can provide you an increased benefit down the road. And then finally, think about the rate of return that you would need to earn on your money, guaranteed and after taxes, in order to mirror or mimic the long-term care benefit. It is dramatic, and typically it's impossible to get. So these policies can be very good. Again, you need to make sure that you understand the policies because they can be a little complicated, but using RMDs to fund a long-term care policy could be a very good strategy. So thanks again for that question. Thanks so much for watching. Tune in next Monday for another edition of Money Talk with Michael. And don't forget to send in your questions and check out our website at fellowshipfinancial.com and our social media platforms. And if you'd like, you can schedule a 15-minute complimentary call to get your specific questions answered. Everything you need is listed in the description box below.